A discussion of central bank operations and interest rate policy by Warren Mosler and Phil Armstrong. Conclusion. Events of the past decade have highlighted the importance for policymakers, investors, academics, and voters of developing a richer understanding of the operation of the monetary system in general and the determination of interest rates in particular. We welcome the acceptance on the part of many economists, including those outside post-Keynesianism, of the endogenous nature of the money supply. Footnote 9. See Ray, 1998, 2007. End footnote. Central bankers have also acknowledged the operational necessity of targeting interest rates rather than money supply growth. Footnote 10. See McCleary, Radia and Thomas, 2014a and 2014b. End footnote. However, we would argue that the process of deepening understanding is not yet complete and further requires the recognition that, as the monopoly issuer of reserves in a floating exchange rate regime, supply is demand determined with central banks controlling price. That is, central bank action under a floating exchange rate regime is best understood as that of a price setter of the reserves demanded. We argue in favor of a reversed causality vis-a-vis orthodox analysis, which would have applicability in a fixed exchange rate regime, which is in fact reserve constrained by design. A full analysis of fixed exchange rate dynamics, however, is beyond the scope of this article. Footnote 11. For a discussion of the monetary policy constraints which accompany the adoption of a fixed exchange rate, see Mosler 1998 and Forstater and Mosler 2005. End footnote. We also contend that its role as monopoly supplier also gives the central bank the ability to control the full spectrum of long-term risk-free rates, and that the extent of market influence on the determination of the shape of the yield curve is always, ultimately, under the control of the central bank.